with breaking news. Yes, we're looking for our fourth quarter final read on productivity and unit labor costs will replace the previous read. So we're looking for 2.5%. Disappointment, 1.7. And that's a real disappointment because it's replacing 1.6. 1.7 is replacing 3%. So that's a big drop. And if we look at unit labor costs, they exactly doubled from expectations. Expecting 1.6 comes out up 3.2%. Our previous look was 1.1, so really ramping up. And if we look at initial jobless claims, they remain under 200,000, 190,000, and continuing claims also besting expectations, 1,655,000. In the rearview mirror, 1,660,000, so sequentially lower on both cases, initial and continuing claims. You could see that interest rates have popped up a bit. We've moved up to 4.06 in 10s. And if you look at the 5 o'clock Eastern close yesterday, it was like 3.99.5. We didn't really close above 4% in a true cash market close. And I don't mean to be splitting hairs here, gentlemen and ladies, but that is significant if you're a technician, especially for the weekly close tomorrow. Pre-opening equities have ticked down just a little bit. As you see, they're still up with respect to what they're looking for on the big 9:30 Eastern opening. We still, of course, will continue to monitor what's going on above 4%, but I can't stress intraday's one thing, but the close, boy, that's technically significant. Joe, back to you.
All right, Rick, thanks. Steve Leisman joins us now with more on this and whatever he wants to talk about. Steve.
Thank you, Joe. I don't think Powell's going to like this, this rise in the unit labor costs. Rick is 100% right to point it out. Major revision. I mean, I think the best you can say is we have no idea what's going on with productivity in this economy. We had a massive surge in productivity with the pandemic. A lot of lower productivity workers were laid off and weren't part of the count, and then they came back in. So there's been this decline in productivity as a result of it. And how that plays into unit labor costs is unclear, but unit labor costs would be rising with lower productivity workers coming back, and I don't think we'll get a good picture of this. I do want to talk very quickly about jobless claims. I hate this job in the sense that there would be a huge sigh of relief out there if claims would finally go up, but there's no sense of that at all right now. We are now in the 7th week below 200,000. Continuing claims came down. No sense at all from this weekly high-frequency indicator that the job market is loosening up. And then one more thing I want to show you, Joe, which is that how there are Fed hikes priced in, but also massive Fed cuts priced in. Take a look. This is the whole story right here. You have 90 basis points of hikes priced in through October, and then through the end of next year, or 2024, you got 130, what do you want to call it, basis points of cuts built in. And that's really the question about, is the Fed too tight? Is the market in line with the Fed? Is the market not in line with the Fed? And that's the tension and the debate right there, right in those 3 bars that you got. Joe?
Yeah. Slowly getting more in line, I guess, Steve. Slowly but surely. Maybe,
but not on the back end.
Right. Yeah. Right. But maybe it gets in line before, because the back end's headed even higher that we don't even know, and we're still X amount away, and now even the terminal thing is even higher, and we're still below that. I don't know. Thank you, Steve.
Sure.
I want to shift gears right now, talk a little bit about Tesla. Elon Musk announcing his Master Plan 3 at the company's Investor Day, close to 7 years after Part 2 of that master plan. Executives reiterated that they want to produce 20 million cars a year by the end of the decade. In fact, here's Elon Musk on the current state of Tesla demand.
The desire for